Tariffs are here, and they're shaking up the auto industry. Dealers are caught in the middle between rising costs, shrinking supply, and nervous customers. What does it all mean for your dealership, and how can you turn challenge into opportunity? Stay tuned as industry experts weigh in.
Kevin, what is your general impression of what President Trump is doing with tariffs?
Generally, I think it depends on what seat you're sitting in, right? The view from the manufacturers is very different from the view from the retailers, different from the view from the consumers. But what it seems to me, the intention here is to bring manufacturing into the U.S. And there's so much capacity, and I mean automotive capacity specifically. And then you have materials, labor, you have input cost inflation to the point where supply has just outrun demand in this country. So with that cost inflation, it invites the potential to seek low-cost regions, right? Produce in Mexico, produce in China, to be able, from the manufacturer's perspective, to be profitable. But that means jobs leaving this country to go manufacture somewhere else. So simply put, it seems to me that it's a decision between, do you want affordable vehicles in the case of the auto industry, and obviously trade goes across many different industries, but do you want affordable vehicles or do you want manufacturing jobs in this country? And it seems like the administration is sort of leaning towards the side of let's bring jobs back in manufacturing, automotive manufacturing jobs back into the United States.
Anything to say, Doug?
I would agree with Kevin. I think Trump is doing what he said he was going to do, and I'm really somewhat confused as to why everyone's so surprised. He has a history of doing what he says. And I think he's recognized that if tariffs were so bad, the rest of the world would not be using them to protect their markets and to build employment within their countries. And but you know, they're unique things. Each country thinks it has a right, like Canada, to protect milk producers that are along the border, and therefore they put a 200% tariff on Wisconsin milk. But it's something that has irritated Trump since his first opportunity to be president. And I think he is just doing what he said he was going to do. And I think he uniquely has taken up the banner for the middle class, which by and large has shrunk dramatically, because the manufacturing segment has left the country for cheaper markets, as Kevin mentioned.
Yeah, and I think also that we, as consumers, look at this from the consumer's perspective, which is this is inflationary, right? The price of everything goes up, and that's bad, and we can't afford. But again, I think really when you pare it back, the question is, do we want jobs? Do we want affordable things, which become affordable, I guess, if we increase the number of jobs and the economy grows in that way. But ultimately, that seems to me what the administration is choosing. They're choosing, like Lloyd said, to bring jobs back to this country. And it has been, the difficulty is that it's not simply I put a tariff on your vehicle, you put a tariff on my vehicle. To Lloyd's point, there's trade across different industries, different products, and it becomes all very uneven. And it seems frustrating, at least from the consumer's perspective, because everything is inflationary.
And I think his goal is to create free trade. I personally don't know if free trade is a reality because of some very micro industries in certain places that have extraordinary political influence, like farmers in Japan. I don't know if I think it's an utopian dream, but I think he is doing what he said he was going to do, and he's trying to create a level playing field, and that we are no longer going to be the one who is financing the economic success of countries who are really playing offense, a very strong offensive game with their tariffs, where we're not even in the game.
Excellent. All right. Question 2. Lloyd, do you think this is good or bad for the U.S. economy?
That's yet to be determined. My knee-jerk reaction is I think this is going to be good. Why? Because I think it's a disruption. I think disruptions, those that are temporary in nature, are ultimately good for the economy, and I believe this is temporary. I do not believe that the rest of the world can win at a game that they currently lead at, and that is they led with their tariffs. And if you're talking about reciprocal tariffs, and if we're taxing them at 3% and we're taxing them at 30, or they're taxing us at 30, and we raise ours to 30, and they raise theirs to 40, that game will not win for them. So I think this is a shorter term process. I think this is a negotiating tool for Trump. And I think on the other side of this, time being the question, on the other side of this, we're going to have a greater investment in the infrastructure and the industrial infrastructure of this country. And we no longer are going to be financing the working class of the rest of the world.
Yeah, and I would agree. Short term, obviously, economic pain, at least as it looks in terms of pricing and an inflationary impact, like almost immediately. But I think the longer term view, achieving what administration is setting out to do would have a net benefit to the economy, right? And creating jobs and and that affordability would go along with having more manufacturing jobs in this country. So, it's sort of the tide lifting all the boats. And I think also, like I said, everybody thinks they should make more money next year than they did this year, right? And that's perpetual, right? And or chronic, so the idea that we can cover that inflating cost structure with more and more product becomes difficult, right? It's just too much capacity for the demand level. And this, to Lloyd's point, is a disruption. It's a reset of that supply demand balance, which is needed, especially in the auto industry, but in the economy overall. Whether it's successful or not remains to be seen. But I think something had to be done, and this is what Trump and the administration have decided, that this is where it's going to start.
Kevin, let me ask you, there has been some consolidation of global manufacturers, and there's been some concern about other manufacturers, currently Stellantis and Nissan. Do you think this is going to promote or hasten any of that consolidation of global manufacturing companies?
Well, I think you need to rationalize capacity globally in the auto industry, including in the U.S. So to give you an example, capacity utilization of automotive factories in the fourth quarter was 65%. You look for 80% to be ideal. It gives you room to expand, but you're not paying overtime to everybody all the time. So there's too much capacity for the demand level here. What that results in is too much supply. You see an inventory build, and then it becomes a race to the bottom in terms of pricing. So combining automakers, to me, doesn't do anything unless you take out some of that capacity, right? And if you think about it, it's what a trade war is. China builds out automotive capacity, doesn't have the demand to meet it. It looks to other countries to put that excess output, including the US, Europe, wherever it is. At some point, and this is where we are now, those countries that are taking those exports as imports say we can't do it, right? This is taking from our manufacturing base. So I think globally, combining manufacturers isn't the issue. Consolidating on the manufacturing, the actual production footprint has to happen. And I think to a degree, this tariff situation, when you look at it, if you're going to have, and for the numbers that which I looked at the other day, 16 million units of sales in 2024, 11 million were built in United States automotive factories. So there's 5 million vehicles that I'd call in play. But then you consider, so then you say, okay, well, there goes pricing through the roof because the consumer choice is taken away. Supply and demand get much tighter and balanced, like what we saw in the pandemic. The issue is that our automotive factories are only running at 65%. So of that 5 million, you could add back a lot of that supply and a lot of that output, and you get to a total volume number that may not be 16 million anymore. It may be 13, 14 million. But if you think back to the pandemic, that was the most profitable time for manufacturers and dealers. So to me, that points directly to the rationalization of automotive capacity, certainly in the US and absolutely globally.
Kevin, what do you think is going to be the turn time for, let's say, companies like GM, which I think currently has 20% of the parts are imported. Ford is, I think, a little better. I think they're at 10. What do you think is going to be the turn time if they're forced to create those parts in the U.S.?
Yeah, that creation of the supply chain, it probably couldn't happen in less than 36, 48 months. And if you think about the way supply chains have built, it's over the course of decades. But as I said, we're already under capacitized in terms of usage with the factories that already exist. And perhaps that narrows vehicle architecture choice, right? And that's happened organically. You think about 2013 was the last time the US was 50% truck, 50% car. Now we're 82% truck. And every manufacturer has truck capacity in the US because of the chicken tax, especially, for European manufacturers. So the capacity is here, right? Supply chains probably have to adjust a little bit, but I think with a lower break even by taking out capacity, 2022 was the most profitable year for dealerships and was near record for the manufacturers. And that was a 13.8 million unit market, nowhere near the 16 that we saw last year. So you had great profitability on lower volume. And I think that's probably what you can expect going forward, is that this is not going to be this perpetual growth market, 16 million, 16.5, 17, on its way to 18. I think we have to keep that lower break even in mind and aim for that and keep supply and demand tight. Everybody's profitability benefits from that. Consumer sees higher pricing, but again, that manufacturing base expands, right? Jobs expand.
Yeah, and to point out a couple of contradictions that might be highlighted today. In 22, I think the Dow was down something like 18%. And the auto dealers had their best profit year that you can remember. And the auto dealers had an extraordinarily good profit year as well. So the sky's not falling, that the stock market is down 7 or 8% in the last few days.
Yeah, no, and I think that's an interesting point, is that from Wall Street's perspective, everybody's focused on the manufacturers, the Teslas, right, and GMs, which are, arguably become uninvestable But there is opportunity there, right? And even those companies, their profitability was very strong in those years. 24 was a little bit better, because that's a business that depends a little bit more on transactions. But when you think of the way I look at it this way is that when you think about the auto industry in the US, a lot of people look at the volume number, the top line volume number. So 16 million in 2024 looks like it's better than 13.8 million in 2022, or the record year of 17.5 million in 2016. But the thing you have to layer on top of that is also transaction prices and the front end gross per unit, which is way better when supply and demand are in balance, right? If you look at, and I call it the revenue pool, if you look at 2016, 17.5 million units averaged $35,000. When you look at 2024, 16 million units averaged $49,000. So that revenue pool is about $140 billion larger by selling 1.5 million fewer vehicles, right? And I think people think the sky is falling because you're selling fewer units, but the pool is actually bigger. The revenue and profit contribution pools are bigger. So the industry actually is growing for working smarter, not harder, right? You don't have to go find 17.5 million buyers. Maybe it's 15.5. Mm-hmm. And it's a lot easier to do that and do it profitably.
Yes. And you can't have a hot beer and a banana with a automobile dealer without him saying, oh, it wasn't it good back in 22 when we had lower volume, higher grosses.
Yeah, I mean, there's something to be said for foot traffic, right? Because not everything is a new vehicle sale, right? There's fixed ops. You think about selling a new or used vehicle to create a parts and service customer also, because that's really where the gross margin is. So from the dealer's perspective, you understand where you want transactions, you want people in the door, you want finance and insurance, you want warranty contracts, things like that. But ultimately, when you think about the new vehicle business, less is more in terms of profitability for the retailers.
Excellent. Good stuff. All right, number 4, Lloyd. With the recent announcement of tariffs, what immediate impacts do you foresee for dealerships, and how should dealers adjust their strategies to address these changes?
Well, I think it depends on a few things. First of all, perspective. If you're willing to deal with change, I think it's going to be a good time. We've been here before. 911, 2009, 2019. I think automobile dealers are some of the most versatile, dynamic businessmen on the planet. I mean, they are the canary in the coal mine with regard to the economy. And I think they have learned to be light on the feet and adaptable. So if you maintain that perspective, I think they'll do fine. I also think that if you're Mercedes, Porsche, Lexus, BMW, Hyundai, Kia, if the bulk of your product is being imported, I think you might feel more disruption than if you're a Ford or a General Motors or Toyota or Honda. I think Ford, especially Ford and General Motors, I think they have the least content. And if you have one of those franchises that rely totally on imports, I think your approach to this is going to be different than the other dealers. And I don't think, frankly, you should panic. I think you should sit down with your manufacturer, listen to them. What are they thinking at their level? What are they believing they're going to be absorbing, and what have they got to be passing on? What do they think the timeline is? How much inventory do we have that is not tariffed, so to speak? And, what's the run rate on that? And I think you also need to talk to your customer. Tell your customer that the sky's not falling. You're going to be there for them, and you're going to provide them the best deal. I think the internet has really hit its peak as far as advertising with regard to automobile dealers. We're seeing a trend back to the more traditional media of TV and radio. And I think this is where an automobile dealer can, keep his cool and connect with his customer and say, we're not panicked. You shouldn't panic. If you're going to need a car in the future, we're going to be able to get it for you. And it might be a little expensive, more expensive, but we're going to find a way for you to have the automobile you need, whether it's modified financing or whether, just whatever it might be. We're going to be able to serve your needs. I think automobile dealers just need to start thinking ahead. Kevin mentioned earlier that automobile dealers tend to think from year to year. Most that I deal with think month to month. I'd be delighted if they thought year to year. But I think now you do need to expand that thinking 90 days in the future. I think everybody's got 90 days of inventory. So I think the world only looks good for 90 days. Your inventory is going to be valuable, and I think there's going to be some pent-up demand. And I think you're going to have a chance to get a little higher grosses if you're patient, if you don't think the sky's falling. Beyond 90 days, I think you got to be out there using your brain, start doing some collaborative thinking, and just believe, hey, we've been here before. We got this. And, the sky's not falling. Kevin, what do you think?
I would agree. I think, for one, the franchise dealer base has great revenue diversity, right? And in times where new vehicle margin is at its peak, you can go focus more on that, right? If the pre-owned market starts to compress a little bit, and I think it's going to stay undersupplied for a while, the used car market, right? You can go to those other business units, whether it's the new vehicle segment, whether it's fixed ops, whether it's F&I, and have the ability to diversify that revenue base and sort of follow the money, in the segments that are hot. I agree also that it's going to depend brand by brand, the impact of price increases due to tariffs. But as I said, there's a lot of domestic capacity for the products that are popular, which obviously are trucks. And this is the direction the industry and the market, the U.S. market, has been moving since 2013. Right. So I think that you're correct that there's excess supply now, probably for another 2-3 months, but vehicles will be built, right? This is not April of 2020 where 4,000 units were built in the entire North America, which would typically be 1.5 million, right? And you think even in that instance, production basically completely shut down except for a couple of Hyundai Kia vehicles built in Mexico in April of 2020. It wasn't until 22 where that supply demand balance got so tight. It was actually the end of 21 to the end of 22 where that supply demand balance got so tight that the consumer was paying over MSRP for those 12 months. And that's every brand in the industry as a whole, which was obviously unprecedented. So I think there's some lead time before you start to see prices get super firm, but we will move in that direction. You look at March, crazy, right? Think about this, 16 million units in 2024. January, February were in that range, right? High 15s, low 16s. March, this pull forward was a 17.8 million unit SAR, right? Completely not organic. That was panic, and that was a rush to get vehicles before the tariffs hit. Now, the stuff that's on the ground is, if it left the port in time, is not tariffed in April and potentially even in May, depending on how long that inventory lasts. But as we get beyond this initial shock, you're going to start to see discounting go away, prices firm closer to MSRP, and and maybe even gets over again. But the thing to consider is that even when that happened in late 21 through all of 2022, demand didn't really change. Discounting went away, incentives were gone, there was no leasing, there was no cash on the hood, but the industry still averaged that same 1.3 million units per month. It was just a matter of how much inventory there was against it. So the demand will be there, right? And the consumer needs vehicles, and the dealers have the expertise and the experience to provide them for what they need. So I would expect more of the same. Super steady demand, maybe a tick lower, but really it's going to affect the inventory side, which will come in line with demand, and that'll drive prices a little bit higher. But the consumer's proven, if your process as a dealer is good, the consumer will pay MSRP, right? Just don't make them stay in the dealership for 7 hours to end up paying MSRP anyway, right? If that process is sound, the consumer's proven they'll be there, they'll pay to that level of demand that the dealerships are familiar with, which is that 1.3 million units on average. And it's an amazing chart. I have it in my presentation. Whether inventory is 4 million units or a million, demand stays the same over the years. It's right there in that range between 1 and 1.5 million units of sales, whether you have 4 million in inventory or whether you have 1 million in inventory. And I think that's what we're about to see again, is that really, really firming up of the supply-demand balance.
And then an enhancing factor to that also is that with this jabber about by Wall Street about inflation, that the forecast for interest rate decline has accelerated. And I heard as recently as this morning is they're projecting 5 rate cuts this year for 125 basis points. I think that's going to be a positive supporting element of business at MSRP and even slightly above.
Yeah, everything to me looks inflationary, and in that environment, I'm not sure how you're cutting rates, but I'm no economist, that's for sure.
Nor I. I think it's a function of Wall Street trying to eat the elephant in one big gulp, and they're choking on it, and they're looking for ramifications, talking heads on TV, and they are saying that they anticipate the Fed will become more aggressive when they see some increasing prices, a return of inflation, and slowdown of the economy.
Yeah, well, and the thing too about inflation, though, is that inflation usually impacts everything, right, including wages, right, across the board. Your returns, in terms of investment returns, right? Inflation means things are going higher, right, and that should mean everything, including your wages and your investments. So, an inflationary environment to me, would tend to show economic strength, and would be when you are not cutting rates. But again, it's, the logic escapes me.
Likewise.
Sorry, I was on mute. Kevin, how can dealers effectively communicate with and reassure their teams about job security and the organization's stability in light of tariffs? What specific messages should leaders convey?
Yeah, I think that, again, we're talking about an environment potentially sustainable and structural change in which the U.S. auto industry is by volume smaller. Right. So fewer transactions, although those transactions may be more valuable, more profitable from a revenue and gross perspective. So I think you do have to be aware that there's that potential to right size your your enterprise to fit an industry that isn't doing as much total volume. That said, I feel like especially the franchise dealer base went through this recently during the pandemic, right? To Lloyd's point, we've seen these shocks before, whether it's 9/11, whether it's the global financial crisis of '08 through 11, whether it's the pandemic, right? So I feel like there was a lot of cost rationalization that happened early on in the pandemic that also helped drive 2022 as a peak earnings period. And so a lot of that works to me has been done, right? We come out of the pandemic arguably sometime 23, 24, and here we are right back into the same sort of supply demand dynamic, which means a smaller market. So I have been saying, like, I think the structural lift is much heavier for the manufacturers in terms of excess capacity, in terms of headcount, and adjusting your manufacturing footprint to focus more on the US and not, globally or even Canada, Mexico. That's a way, way more financially burdensome task that they have relative to the franchise dealer base. Again, I feel like they've been through this very recently, and if they're not completely right-sized to a smaller market, they're pretty close already.
I think dealers figured out back in 09, 10, and 11 that they could no longer run their dealerships from their ranch or their sports fishermen. I think they're back engaged. If not granularly, they have supervisory management that is really communicating daily, who's in touch daily with their management teams. And I think this, the results of what we did in 18, how we recovered from that, reflect that these dealerships now have been professionalized and they are communicating with management. And in this crisis, I believe they're going to do that right away. They'll be telling their management teams that, hey, I'm not panicking. You shouldn't panicking. Nobody's job's on the line. We got a challenge ahead of us. We've been here. We've done this before. We're going to do it again. We're going to have to stay in contact with our manufacturers. We're going to have to know what's coming before it gets here so we can be prepared. It's a function of a team acting like a team, and practicing the OTA cycle, which I'm a big fan of, which means observe what's going on in the economy, observe what's going on in the dealership with our local community, what's going on internationally, observe what's going on constantly, and constantly orient ourselves to it. So you observe, you orient, you're constantly deciding what you're going to do, the action we're going to take. Then you're going to act on it. And then you're going to observe the consequences of your action and start the cycle over again. Observe, orient, decide, and act. That's the way management teams work. And that's the way management teams effectively deal with somebody moving their cheese, because the cheese is moving all the time and we've got to get ahead of it. And we learned that we're going to do well. Automobile dealers are going to do a heck of a lot better than washing machine salesman. I don't know if I'd want to be running a Best Buy store right now. You got to believe that probably 90% of their merchandise is imported. The car dealers aren't that bad. We're going to do okay.
Great. Okay. Dad, in response to potential price increases, what innovative strategies can dealers implement to maintain consumer interest and dealership traffic?
Well, I think the most important thing they can do is communicate with their customers. Tell the customers they're not screaming the sky's falling. world coming to an end, and the customer shouldn't think so either. Convey your confidence in your brand, convey your confidence in your service team, and invite people to come in for service and tell them that they're going to be provided a value, that we're going to squeeze value out of any kind of tariff impact that's out there. I think communicating with customers is paramount. And my dog agrees too.
Yeah, and I think also there's going to be message from the manufacturer through the retailer that will need to be communicated, because as of now, essentially every brand, every manufacturer has a strategy on what they're going to do, and what do you and that goes from assuming all of the additional cost to none of it, passing it along. There's the entire spectrum of what manufacturers are going to do, and I think dealers are already out there with those manufacturer meetings, finding out what the message is, and then I think though there's going to be this sort of frenzy right now. We've seen Ford employee pricing for all. I think Nissan has done some price actions on certain products. And again, I think that at the end of the day, that's all just inventory management, supply demand balance. And as we get out past this 60, 90-day period, it's going to become even more important to be communicating with the customer, with your team on what the direction is, because that's when supply demand is going to get even tighter. Prices are going to go a little bit higher or be a little bit more firm. Maybe they're not over MSRP by the end of the selling season or into the new model year in the fall, but it'll certainly be closer that way. But again, I think what the consumer, what markets fear in general is that uncertainty. So anywhere that a dealer can take away some of that uncertainty is beneficial, not only for them or their manufacturing partner, but also for the consumer.
Great. Getting close. Kevin, what are the most critical supply chain adjustments dealers should consider to mitigate the impacts of tariffs, and how should these adjustments be prioritized?
Yeah, speaking to dealers already, those high turn parts for your service bays and your parts counters. So there's probably a little bit of pull forward in terms of those. A big one is tires, right? That everybody needs, nobody thinks about, that are going to get more and more difficult to find and be more expensive. So I think you're going to see a lot of this buy-in early, or have already seen it, to be prepared for those things that are high turn items. It's sort of like the big box store. You don't need 7 gallons of mayonnaise, except you're eventually going to use it. So I think it's a little bit of that. The parts you're going to turn, whether it's filters, whether it's brake pads, things like that, the things that you commonly are using. I think the dealer base has already been out there accumulating those products.
I think a used car pre-owned strategy is going to be very important to some franchises. And this is a fickle market as we speak. Dealer after dealer is trying to enhance their pre-owned, and they're all encountering challenges because everyone's in the market to buy the wholesale units at the same time. But that is a business that you can depend on. That is a service business that you can depend on, and it's not going to be tariff impacted, other than as the parts that Kevin mentioned and the tires. But I would definitely be thinking about an aggressive pre-owned strategy that was going to keep my service department going and was going to keep my F&I department going, and that even without generating significant gross profit on the front end, that used car business will be critical if the cost of new cars creates sticker shock. And that will happen. I think the economy, our population will adjust. We've got to figure out just how much of this is permanent and how much of it is not. And that's probably going to take the rest of the year because everybody says Trump is a deal maker, and we're all expecting him to make deals, and that none of us are expecting that this is the final edict on tariffs. But when it does settle in, we're going to have to make some adjustments, and I think used car perspective commitment is going to have a significant impact on the winners and losers in this environment.
Yeah, let me add a little color on the pre-owned market as I see it. Undersupplied currently, and a lot of that has to do with the lower volume of the pandemic period. So when you think about that tight supply-demand balance on the new vehicle side, incentives basically went away, and leasing is a form of incentive, right? It creates affordability, it generates transactions. So you combine a lower total volume in the market through the pandemic period with low lease penetration, and that 3-year average lease term means that 36 months down the road, what comes back off of lease, and again, that's a small part of the total 36 million used vehicle transactions per year. But they are the late model, low mileage, sort of best, highest contented off lease, used vehicles. So when you think about pre-pandemic, just to put round numbers on it, the industry averaged 17 million units up until 2019. Going back, let's say 5 years before that, lease penetration averaged 30%. So 30% on 17 million units is roughly 5.1 million units coming back 3 years into the future. Then you get to the pandemic where we get, 2022 is a perfect example, a 13.8 million unit market with transaction prices over MSRP, indicating the customer isn't getting any incentive at all, including a good lease deal. So leasing in 22 on 13.8 million units was in the teens. So it goes from 30% to 17%. So in 2025, which is 3 years later, we're talking about 2.4 million off-lease vehicles to a market or a segment that is used to 5 million every year. So cut in half, it starts to rebound a little bit in 2026. But what we sell in 2025, if this is a supply-constrained market and we go back to a 15 million or a 15 and a half, with tight pricing and no incentives, by 2028, this used vehicle market is very tight again. And not that you can't make money in a tight market, it just means that you may be paying a little bit more to acquire vehicles, because in that space, you're competing against not only the Carvanas and CarMaxes of the world that are only used vehicles and have to get inventory for themselves, but you're also dealing with the consumer who sees prices going higher and higher and higher and will just sell things themselves because it's easy to do. So there's opportunity in the pre-owned market, but it's going to be it's going to take great expertise to really navigate that and find the profit path within that really, really tight balance.
I would say that in addition to expertise, it's going to take some huevos magnos. Because in most cases, you've got to step out and pay more for that used car. And there's no assurance based on history that you're going to get a good return on it. You might actually lose money on these new used cars. To give you a perspective, I think last year, the average age of a used car was 11 and a half years. 11 and a half years old, the average age of a used car. This year, it has already gone up to 12 years. It's gained people are holding on to these cars. It's hard to get a used car out of the hands of somebody because they're thinking, heck, if I sell this car, I got to go buy something more expensive, just like housing.
That's right.
And
Yep.
but you gotta not only do you gotta be smart, you're gonna have to be brave. You're gonna take some chances. And hey, you're talking about the car dealers.
Yeah, and I think the what's an interesting angle there is you have franchise dealers who have obviously relationships with their captive finance company. And, when you think about it, right, they know what leases are coming back. They know, who's financed, how old, the finance companies know a lot of things, at least the captives of the manufacturers. So I would think that there would be a lot more or a tighter direct relationship between the franchise dealer base and the captive finance companies, all the manufacturers. What we saw a lot during the pandemic, and that was a little bit different because people didn't drive as much, right? Commuting, shopping. There was a lot more isolation during the pandemic period, but anything that was leased, let's say in 2018 or 2019, that was coming off lease during the pandemic was way below its mileage. So the residual value relative to its street value was very low. So you had a lot of people buying their own off-lease vehicle, which I don't think you'll get this time. So it may free up a little bit more of the market just because we are traveling. So mileage should be, which has already returned to normal. When you look at highway miles traveled in the U.S., it's already back above where it was pre-pandemic. So I think that'll loosen things up just a little bit, but I just don't think you're going to get those lease deals in the first place because automakers don't have to create affordability in this market of tight supply and demand.
Yeah, the used pre-owned market is a great opportunity, but it's going to take thought and bravado.
All right. I don't know who I went to last, so I'll go with Lloyd. Considering the changing market conditions due to tariffs and executive orders, what advice do you have for dealers who are thinking about buying or selling dealerships right now? How should they evaluate the risks and opportunities?
I think from a simplistic perspective, it's a bad time to sell, and it's potentially a good time to buy. I wouldn't be thinking of selling over the next 6 months unless I had an extraordinary franchise in an extraordinary location, or I was on a cliff emotionally or financially. On the other hand, there are always going to be opportunities, and I think those dealers who have dry powder are probably going to see some opportunities because every time we have one of these exciting times, like 9/11, 2008, 9, and 10, 11, 2018, every time we have one of these, a certain segment of our weary dealer body says, I'm out. Bring me a viable value, and I'm out. And those who are committed to their craft, committed to their profession, need to have their feelers out there and be alert because there will be some opportunities that become available. Your thoughts, Kevin?
Yeah, and I spent a lot of years basically looking at this from a Wall Street perspective. So I'm still learning about the deal market in terms of dealerships, and the Presidio team has done I'm very grateful for the help that they give me in this. But one thing we talk about all the time is that that valuation is really tied to the earnings side of the equation, right? So you think about any deal, earnings times a multiple. And it's not really the multiple that changes, it's the earnings dynamic that changes. And I think, to me, this looks a lot like, right? So when you think about the deal market through the pandemic period, earnings through the roof, right? So valuations go up, not because of the multiple, but because of those really strong earnings. And again, as we get into this tight supply demand driving revenue and profitability, I feel like we're heading back in that direction, which is, if you own a dealer thinking of selling it, you're going to be able to command valuation just because the earnings side of your equation is strong. And we've seen that start to come down, right? The earnings have come down, oversupply back to 3 million units of inventory, right? So gross on the front end is compressed a little bit. Still better than it was before the pandemic, but certainly not what it was at the peak. So now we take a turn back in the other direction. And I think that's where, that to your point, Lloyd, there's a personal situation there that will make you either want to sell or buy, and that's going to vary from person to person. But I think ultimately what dealers can expect is if you want in, sooner rather than later, because I think the turn in valuation or values is going to go higher due to that earnings side of the equation being stronger.
Kevin, that being said, I think based on our experience as succession planners, we found that the market reps of Presidio really have the experience, having gone back through these market cycles in the past. And depending on whether they're dealing with a buyer or a seller, they really have an awful lot to offer. And I would have to suggest that any dealers who are thinking on the buy side or the sell side, that they talk to the people who've been through this before and get some validation on their thinking and or new thoughts, because this is really not new ground. We've been here before. And people who have been dealing in this market as long as Presidio can really offer some very solid background to thinking and very solid information on which you can make good decisions.
Yeah. Thank you for doing that commercial, so I didn't have to do it.
Yeah, I'll send you a little bill later.
All right, 2 more questions. Kevin, for dealers planning the future of their family-owned businesses, how should they approach the buy-sell question as well as long-term growth and succession planning in this new economic landscape?
Yeah, that's a really personal question, depending on location, size of the dealership, the brands that you're representing, so there's a lot there. The one thing that I would say again is that expect that this is a smaller market, right? And understand your brand's place in that market, probably stronger or more solid price and margin environment in that lower volume. But really, it just depends. I mean, there's probably a million reasons why you want in or you want out. I would think that in a lot of cases, the trend, like Lloyd referenced Best Buy earlier, right? That there was this move towards consolidation where you have big players getting bigger and you have sort of mom and pop just getting out because it's difficult to compete with scale in so many different industries. So again, really sort of personal choice. I think, it just really depends on the family dynamic, who's next in line, what your consideration for the brands you hold are. But like I said, I think that the thing is to expect that this is not a market that is going to be perpetually expanding its unit volume. I think as a mature U.S. market, we can expect that organically and healthy volume for us is in that 15 to 16 million unit range. And the expectation that it goes much higher than that is probably not only not realistic, it's probably not healthy either. It's not really good sales and good profitability if the market were to turn to that. So things to consider, but I really have that's going to be a very personal choice.
We work on the personal level with the families, and they have, since 2008, 9, 10, 11, they have come to the table. and those that are committed to the craft, committed to their business, are alert. They're aware of what's going on. They're in touch with their industry. They're in touch with their community, in touch with their manufacturers. Those that are not have been weeded out, or they're going to go during this cycle. And I think these family-owned businesses need to just continue to focus on they are professionals. They're prepared for this, and they do have questions how they're going to react, and they can find adequate answers. And they need to work with their environment. Just make sure that they're in touch with every dimension of their business, from manufacturing to distribution and sales and employees. And if you're planning on selling, talk to people who've been down this road, who I would say get a feel for what's happening. We're going to know pretty quickly, is this going to be a positive or negative to the net value of a dealership? And I personally cannot see how it's going to hurt it. There may be some specific manufacturers that are hurt, but the market's going to adjust. I think it's going to be additive. That's my feeling long-term for automobile dealerships. And I'm not sure I would change my plans dramatically. I just wouldn't be making any impulsive decisions. There are a few more factors you need to take in regarding what franchises you want to buy and in what locations you want to buy them. And the next few months are going to give us insight into that. I personally think that these manufacturers like Toyota, Honda, Kia, Ford, General Motors, they're going to adapt. They've been through these cycles too. They're going to adapt. The sky's not falling. They're going to be okay. And if you're planning on growing and expanding, continue to plan on growing and expanding. If you're planning on selling, then take a deep breath, talk to people in the know like Presidio, and develop some extended plans. It might take you a little longer because there are going to be a few more questions by buyers. I have no doubt you'll get your value.
The other thing I would say too is that I am not considering that, or if dealers or franchises are considering the threat of direct sales, whether from the factory or from a big marketplace like Amazon, I just don't see that as being realistic or feasible. I think the franchise base is experienced and established. And I think even if a manufacturer were to try and recreate or to go direct to the consumer, they would wind up recreating the franchise base that already exists, right? And then you have not only that new vehicle distribution expertise, but you also have after sales expertise, whether it's in F&I or whether it's in fixed ops, parts and service, or used cars, right? So I wouldn't, obviously I would never tell anybody what they should be doing, but if your concern is the agency or the direct sales model, I don't think it works. And I don't think it certainly doesn't work at scale. And I think that while people will point to a model like Tesla and say, well, they do it very poorly, right? And they do it very unprofitably. So you hear from one side, and I really don't think, I think any of the direct sales or agency sales talk you heard during the pandemic was a function of that very tight supply and demand balance where inventory came in today and was gone late today. And then you had manufacturers look over and go, well, boy, we could do that, right? Anybody could do that, and they can't. And especially in times like these where the consumer needs guidance, they need input, they need experience and expertise. Manufacturers can't do it. And even from a consumer's perspective, where I hear all the time, like, oh, just cut out the middleman, it would be easier. And I always have the same answer, which is, if you think it's difficult to interact with a dealership about your new vehicle or service or whatever, wait till you try and go directly to the manufacturer with those same issues. You think it's bad now, it would be 100 times worse because they're manufacturers. They're not retailers. They have no experience in doing it. They have no network or scale to do it. So if you think you can, just because you're a manufacturer, you can magically become a retailer, it just doesn't work that way. So, that would be the only advice I would give, is to say, if that's your fear, I wouldn't be making decisions based on that potential reality in the future at any point. I think quite the opposite is true, that manufacturers need to lean even harder on their franchise base to distribute more expensive vehicles, right? To help understand what this means in terms of tariffs for them. So I think the manufacturers need dealers now more than ever.
I agree. I believe that the United States automobile dealer is a unique entrepreneur who has done so much for so long with so little. He can do the impossible with nothing. And he reinvents himself every day. And that's something manufacturers do not do well. They are process oriented. They do not change on a dime. And the retail marketplace, you got to be dynamic. You got to be brave. And I think the automobile dealer is in a very secure position.
All right, last question. Lloyd, amidst this new set of challenges, what opportunities might tariffs present for car dealers to innovate or expand their business models to stay competitive and successful?
Well, I think the most important thing they can do is connect with their customers. Just tell them that they're not planning to gouge them. They're planning to be there as their partner in their endeavor to secure quality transportation, and that keep your wits about you. This is not a time to be taking impulsive action, being afraid that you're not going to be able to get an automobile or the price is going to go up 25%. Americans in general just really do well at this. And Donald Trump is a disruptor. He knows what happens in disruption. Opportunities are created. And I think the dealer has an opportunity here to connect with his customer base. I think he also has an opportunity to start drinking some Kool-Aid of his manufacturers, because he needs to be on the inside of the information, the real information of what his supplier is providing him. And if you've been of the class who think the manufacturers are idiots, I think you need to basically pack that opinion away, join the team, and try to give them good information and endeavor to solicit good information from them that can help you refine your business plan. And it's going to work out. It's going to work out.
And I think the challenge and I don't think they have to sort of reinvent. I agree with that. And especially if the dynamic of supply demand balance is very similar to what we just saw through the pandemic period. I mean, that story was written and now it's sort of coming back around. What I will say would probably will be one of the bigger challenges, and this was the challenge during the pandemic, is that it is the dealer that sits between the manufacturer and the consumer. So whether it's pricing, and that may mean higher MSRPs or additional fees, whatever it winds up being, it is the dealer that sits across the desk from the consumer, and in many cases feels the wrath of the consumer for those things. But ultimately, as a translator between the two, the opportunity is obviously great, right? So I think that's coming back around as well, where why don't you have these vehicles? Why is supply so tight? It's not the dealer's fault. They're trying to, they'll sell anything, a bag of sand, if they can make money on it, right? It's just a matter of, this is what we have from the factory. These are the products they're producing. This is what they're sending us. This is what the pricing dynamics look like. And we're on your side, but we're in between both the manufacturer and the consumer, and that can get a little bit sticky as there isn't inventory as far as the eye can see anymore, or there isn't this sort of haggle ability where you can get 2,500 off MSRP just by walking in the door anymore, or there's no lease deals. And again, this is a lot coming from the manufacturer or the macro dynamics, but it's the dealer that is sitting across from the consumer. So that's probably something to be prepared for, and to collaborate and think on for when you do have to have those conversations with the consumer.